Welcome to the latest installment of ABL Advisors video series featuring thought leaders from the commercial finance industry. I'm Mike Togley, the publisher of ABL Advisor, and today my guest is Chris O'Connor, the president of Second Avenue Capital Partners. Thanks very much for being here today, Chris.
Thanks for having me, Mike. I really appreciate it. Nice opportunity. Thank you.
It's our pleasure, believe me. What I'd like to do is start in on the topic of today's conversation with you, and that is to gain your insights into what's happening in the middle market retail sector as a specialist playing in this area. So with that, I'll start in with the first question, if I can, and that is, the COVID-19 pandemic, we all know it caused a lot of havoc on the retailers, and it was significant. However, there were some retailers that did not get as negatively impacted as others, and it was interesting to watch some of those. Certainly those who had an online presence didn't suffer as much. But were there any other factors besides the online presence that allowed some of these retailers to stay healthier than others during this time?
Yeah, well, I think you're exactly right. There's no doubt that most retailers, their customers' ability to buy online was the source of its cash flow and its survival for most retailers. In the pandemic, there was what was deemed essential retail, such as grocery stores, drugstores, hardware stores, mass merchants. And so they stayed open during the pandemic when a lot of retail was closed. So, and at that time, if you can remember, there was a lot of panic. There was a lot of uncertainty. No one knew how long this was going to, go on. And so people were going out and buying supplies and grocery products and paper products. And so sales really, went through the roof in those categories. And so folks get out there, they needed to buy the supplies to make them feel comfortable that they were going to be able to weather the storm. In addition, because there was only a certain amount of retail that was open, the competition wasn't as fierce. So the retailers that were open got a bigger slice of the pie. And so those retailers during COVID did quite well. When the stores did start to reopen, I think there was in the beginning, there was probably a period where folks were still nervous about going out in public. There's still a lot of unknowns, but as they got more comfortable, there were segments of retail that came back pretty strongly, and folks both went in the stores. They were creative in ways to buy online and pick up at the store. So we saw sales start to come back as states opened up and the retail was able to open their stores again.
Yeah, it's interesting because it seemed that there were those that, as you said, the essential retailers, and then those that were nimble, that were able to figure out how to change their model a bit with curbside pickup and things of that nature to make the difference. Okay, so I'll jump into my second question, which is sort of a commentary on what people seem to be saying over the past few years, and that is that the saying is that brick and mortar is dead. It's going the way of the typewriter. So I'm curious, as a specialist in that middle market side of the retail, what do you think about that statement, Chris?
Well, it's funny. I hear this a lot, and Mike, I can guarantee you that bricks and mortar retail is not dead. It certainly has its challenges, and it's going through a transition. But even prior to COVID, retail, the retail model was under pressure from e-commerce. Most successful retailers had to have an omni-channel, strategy where they had e-com or catalogs in bricks and mortar, and that really worked well. And there's no question that during 2020, there were a number of store closings. Thousands of stores closed throughout the country. But in addition to that, there were retailers that saw an opportunity. And so looking in the press, Target is planning to open 40 stores this year. Ultra is planning to open, Ultra Beauty is planning to open 30 stores. Tractor Supply is looking at 80 stores. And Sephora, the cosmetics retailer, is looking at opening 260 stores. So these retailers see this as a real important part of their overall retail strategy. In bricks and mortar, they're expanding on their footprints. And I think from their perspective, the consumers always going to want to go into a store and look and feel and buy product, not only online. I think there's going to be a tremendous, continued surge in online, but bricks and mortar is always going to play a part in the way that people buy products.
Great insights, Chris, and that's why I wanted to ask you that question. I figured that you would have some sort of a strong answer on that. Now, as a lender focusing on the retail sector, it seems that things have changed over the past few years. So I'm thinking about underwriting and things of that nature. So, what does it take to succeed today as a lender in this sector compared to, say, 5 or 7 years ago? Has the underwriting changed that much? And have the borrowers' expectations really changed in line with that?
I think from the lender's perspective, we've been very fortunate in that the folks that we have working at Second Ave really have, a history and experience working in consumer products and retail. So specializing in a segment and being really knowledgeable about that segment is invaluable. And I think when we go out and meet with prospects or with our borrowers, being able to talk their language is really meaningful. It gives them a sense of confidence that we really understand their business, the cycles and seasonality of the business. And it really it helps them feel like we're more of a partner in trying to help them, accomplish their goals. I think from the borrower's perspective, what we've seen a lot this year is liquidity. Folks are looking for maximum liquidity. And we look at transactions. Some companies are looking to leverage their assets in order to fund growth. A lot of private equity groups, and we work with private equity companies that own retailers, and rather than put more either equity or sub debt in, they want to leverage their working capital assets. And we're able to provide more liquidity by lending deeper into those assets. I'd say the other thing that is important to them is speed of transactions. There's been a number of deals that we've done this year that we've done. I think the fastest loan we've closed was 17 days, but we've closed a number of deals within 30 and 45 days. And so being able to react quickly, underwrite transactions, get our arms around it, and then being able to give confidence to the prospect and the borrower that there's a certainty to close. We know that once we get our arms around it, underwrite the transaction, we have a very high certainty we're going to be able to close the transaction. Those are really important. Liquidity, speed, and certainty of close are really important things for the borrower, typically when we're talking to the folks that we work with.
Okay, so staying with the idea of what's important to the borrower and what's important to you as the lender, when you're underwriting a transaction today, do you find that the depth of management experience is still as important as it used to be, or have things changed from that perspective at all?
Yeah, no, management is, and I know you were a lender in a prior life, and management is very important in a lot of different aspects. First of all, integrity of management, knowing who you're doing business with, having confidence that they're going to be honest and you're going to be able to work with them is vital. It's a huge part of our underwriting thesis. But also getting a sense for their competency, their ability to, create a strategy, build a plan, and then execute to the plan is really going to be the determining factor on whether a company is successful or not. And when we saw during COVID is a number of our borrowers and the most successful borrowers reacted quickly. They saw what was happening. There was a lot of uncertainty. No one knew where this was going to go, but they reacted quickly to make changes in their business, and they thought outside the box. And those are the folks that really have, were able to make it through in a good liquidity position, and then bounce back and open up really strong once the market opened up again.
That's interesting, Chris, because I would think that as a lender, it would give you another feeling of confidence when you're dealing with that borrower, because this was an unprecedented event. You never had a reason for, when you underwrote a transaction or were going to underwrite a transaction, to ever think that deeply as to whether or not the management team was going to be, forward-looking enough to be able to react quickly to make these type of adjustments. So does it sort of set the stage to say to you, there are those that we really know have that much more experience, that they really know what to do now that they've even been through something this difficult?
You're exactly right. It was unprecedented. I don't think anyone could have ever predicted it. But again, when we're underwriting, we're meeting with management, the strength of management is always important. And so you get a sense for folks who understand their business, who've been through different cycles and been able to react to it, and who have prior experience in retailers that have been through similar situations, both ups, strong cycles and down cycles. So getting a sense for management's capability is really important.
Okay, great. And so what I'm going to do is I'm going to ask you a question about what's going on with Second Avenue Capital, because you had a very interesting year. You were very active in the market. In the past 6 months, you closed a number of deals, including Untuckit, a high-profile transaction, Francesca's, Solstice Sunglasses, just to name a few. And while many of these companies experienced their own challenges during this time of COVID, was there any commonality to underwriting these transactions, or were each one of them that different from each other? And we could talk about that, whether it be related to COVID or not, but was there any commonality between them?
So I think there's always commonality in that we try to look at and understand the value in their inventory as the primary collateral class that we lend against. So there's commonality in structure, but in each one of these circumstances, the circumstances were different. In one circumstance, we provided DIP financing to a company that was going into bankruptcy and wanted time to be able to reorganize. Their existing lender didn't want to give them the time, so we were able to step in, provide a structure that worked for them in bankruptcy, and then we rolled it into an emergence facility. For another borrower, it was a PE firm that had a company that they were looking to leverage their assets. It had COVID certainly affected their business, but there were strong fundamentals, and they just again want to leverage the working capital assets to continue to help fund the growth. One of our borrowers had a really successful business model. Cash became a little tighter because of COVID, and again, we were able to put together a facility around a number of different asset classes that gave them the liquidity that they were looking for. So. Part of our business is always going to be lending to companies in some level of distress, and we've lent to companies in a number of different stressful positions. And again, their liquidity, driving liquidity, and helping them structure a loan that lets them use that liquidity to execute on the turnaround plan was really important. So there are certain things that are similar within the loans themselves, but the circumstances all tend to be very, very different.
Okay, fair enough. Certainly a lot of high-profile transactions there. I'll wrap it up with my final question, Chris, and that is, we're emerging from the lockdowns. Everyone's out and about again, and we're seeing people and pass by the malls. You see a lot of the parking lots being full and such, and it just makes me think that there's a resurgence to some degree of, I don't know if it's a euphoric feeling of going back to the retailers, the brick and mortar locations. I'm curious, do you think it's possible, in light of what you said about some of the other retailers that are investing in new facilities, do you think that we might see some new unanticipated highs in retail sales in the actual locations? It seems that all the growth seems to have been typically on the online side, but do you think maybe we'd see an unanticipated growth on the retail side, actually in the stores?
We're actually already seeing that, looking at 2020 is a difficult year because of all the uncertainty and upheaval with COVID. But we're looking at our borrowers and comparing them to 2019, which is a more traditional year. And even when you compare their sales levels month to month basis compared to 2019, the companies are performing exceptionally well. So I think we've talked about this a little bit. There are categories in retail: home furnishings, home accessories, home improvements, areas where when folks were spending so much time at home, they're looking around their physical space and wanted to change it. So those retailers started off really strong. We started to see the consumer come back fairly strong starting in July. And I think obviously the second quarter of 2020 was not good. It was very weak because of store closings. The third quarter and fourth quarter came back really strong, and we're seeing, based on the numbers that have been published, the first quarter and coming into the second quarter of 2021 continues to be strong. And so we're seeing different categories of retail starting to perform really well. Women's apparel that lagged some of the other retail categories is starting to come on very strong. So we're seeing that resurgence when the consumer has the opportunity to get back into the stores, there's been a period of time where they really haven't bought product. They have to make up for some lost time. They may be going back to work. So the type of apparel that they're going to wear is going to be different. And I think what we're expecting to see in the next few months is back to school is a really strong season for a lot of retailers. And last year, the majority of schools were not open. This year, they will be. And so we're expecting to see back to school sales be very, very strong starting in July and going through September. So we're very bullish on retail and the level of activity that we're seeing and that we believe we'll continue to see through the end of the year.
Well, it's good news and it's positive news, and that's what we like to hear after what we've all been through. Chris, that wraps up my questions for today, but is there anything I left out that you'd like to say before we part ways?
No, I just, Mike, I appreciate the opportunity to meet with you and talk to you today. We've been lending into the retail, industry for a long time. Very comfortable with it. Love talking about it, and so I appreciate the opportunity to be here today.
Well, it's our pleasure, and I'll tell you what, we'll probably want to revisit with you in about 6 months or so to see how things shook out through the end of the year. So we'll leave
That'd
that on the
be great. I
calendar.
welcome it.
Sounds good, Chris. Thanks very much for your time and have a great day.
All right, Mike, you too. Take care.